Bank stress is surging. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it appears that everything is okay as the government has stepped in with an unprecedented backstop of all deposits at all banks, and yet behind the scenes, interbank funding stress level is surging at the fastest rate since the global financial crisis when Lehman Brothers collapsed. We're going to take a look at what is going on with financial stress, why this is such an issue, and why it means that the problem with the regional banks is nowhere close to being over. Plus, we're going to take a look at the big question mark on everyone's mind for next week is the Fed going to continue to hike rates in the face of inflation, or are they about to capitulate due to the problems in the banking system? Let's over to Zero Hedge, where we picked today's story up with the headline, USA sovereign credit risk hits record high as interbank funding stress explodes. In systemic banking sector, credit risk fears are rising rapidly as the FRA-OIS spread has spiked to its highest since pre-Lehman. Now, if you're not familiar with the FRA-OIS spread, let's take a look at what that is and then try to understand why this is such a problem. So when we look at the chart, it'll make perfect sense why we're seeing such an issue that's only going to make things worse for the regional banks. The FRA-OIS spread is an important indicator of funding stress in the interbank lending market because it reflects the perceived credit risk between banks. The FRA rate represents the market's expectation of future borrowing costs for a bank, while the OIS rate represents the current borrowing costs for the bank, the difference between their two being the spread reflecting the perceived credit risk of the borrowing bank. So when you see the FRA-OIS spread blow out to the upside, it means there's a lot of risk in the banking system, because in normal times, the spread between the two should be relatively close, meaning that current lending rates and future lending rates are relatively the same. But when you start to see that change, when you see this thing blow out to the upside and banks have to go out and borrow at the FRA rate in the future, what it's telling everyone is, hey, you've got a potential liquidity crisis if you're willing to pay a premium today to get money tomorrow. And then in terms of broadly speaking, what this means for the banking system is it says liquidity is drying up because suddenly banks who normally like to lend to other banks are thinking, wait a minute, I think you've got problems over there, so I don't want to lend to you. And next thing you know, liquidity dries up and now you have the seeds for another crisis. So let's take a look at this chart, because I want you to see that this thing is at the worst it's been now and growing at the fastest rate since the Lehman Brothers crisis. And here we can see the FRA minus OIS spread. And what do we know? Going back here to the global financial crisis, drawing a crudely yellow line across the horizon, here we can see that this thing has just blown out to the upside. Now, in normal times, you'll notice that the spread is relatively low. You see down here, there's nearly nothing exciting going on. But you'll notice during the global financial crisis, it blew out. Here we can see we almost had a double dip recession around 2012. It blew up. We noticed going into 2018, 2019, what happened at some point in here that we saw the Fed start to cut rates as stress levels got high. Here you can see the pandemic, and now we're seeing again this is happening. So what it's telling us is there still are perceived problems in the banking system that are not being addressed, that this isn't simply an issue of guaranteeing deposits by the government. There's actually something going on that's much serious underneath. As a reminder, the last time the FRA-OIS spread was here, this was back in March of 2020, the Fed was launching a $1 trillion repo rescue plan and bought corporate bonds and reinstated multi-trillion-dollar QE. It'd be unrealistic to think the banks aren't being more discerning about who they're going to lend money to. And it's relatively contained in the U.S., but of course, there's going to be stresses in the banking system when people are looking at each other's business models, wondering who's got an issue, because one of the big things about being a bank is when you lend money out, you want to know you're getting it back. And in this case, they're wondering if some of their peers are just not in a good shape financially, and they may be the next banks to fail, which might seem unusual given the backstop of deposits, because it's not just about deposits. As you'll see, those deposits are still going to leave the regional banking system despite the government's attempt to say, look, your money's safe. People just don't believe it. The too big for fail lenders, this now from Bloomberg, rake in deposits after three banks fail. So again, we're seeing a surge in money still flowing out of the regional banks. And what I want to suggest to you is this is going to continue. This isn't just a 1 or 2 day issue. This isn't a matter of the government saying, hey, don't worry about it. People are going to be thinking twice about moving, if not all of their money, at least some of it. JP Morgan Chase, the largest U.S. bank alone, received billions of dollars in recent days, as Bank of America, Citigroup, and Wells Fargo are also seeing higher than usual volume, according to insiders. The top 6 banks in the U.S. are and have been too big to fail. The financial crisis over 10 years ago demonstrated that, so it's safer to go with a name with a higher degree of certainty, and perhaps one that seems to also have an implicit guarantee by the Federal Reserve. We've seen them bail out the big banks before, and so what do we know? What happened with Silicon Valley Bank? Of course, we saw this issue with payroll companies and people just being unable to access their money. Now they see perceived risk here, so what are they going to do at their bank? Maybe they're banking at a regional bank or a local bank. They're going to move some of that money to one of the big banks. Even if they don't move all of their money, they're going to move some of it. That's still going to put pressure on these banks who are sitting on these unrealized losses from their bond portfolio, which means what are they going to eventually have to do? Well, You've got it. They're going to have to eventually sell them. And one thing that we do see some selling in here today is, of course, with the S&P 500 surging today, but notably the machines are actually still going short or are going to get whiplashed on the fast algorithms. But as we've talked about in the Sunday show, the slower machines are still selling across this week. And this report, again, $30 a month, 30-day money back guarantee, shows you how the machines are positioned, because what's going to happen in the banking system, as I'm about to show you, is going to get worse. And now we see this from Moodys saying, hey, we're putting out some downgrades because we don't buy this government guarantee either. As Moodys puts First Republic, 5 U.S. banks on downgrade watch, and here we see Western Alliance, Intrust, UMB, Zions, and Comerica were all lenders put on review by Moodys as the credit rating company cited concerns over the lenders' reliance on uninsured deposit funding and unrealized losses in their asset portfolios, because what you can see is still money leaving these banks. So the notion that all this money now, hey, is going to stay there because the government says don't worry about it, well, we know that people are worried anyways, because even if the government guarantees it, they still want to make sure they can get their money if the bank fails. And sure enough, that's what Moodys is thinking too. If it were to face higher than anticipated deposit outflows and liquidity backstops proved insufficient, the bank could need to sell assets, thus crystallizing unrealized losses. The First Republic said earlier that it has enhanced and diversified its financial position through access to additional liquidity from the Federal Reserve and JP Morgan Chase. So the other side of the story is you're saying, well, wait a minute, didn't the Fed step in here and say, well, we are going to do some asset loans against your existing unrealized losses, we'll lend them back to you at par, you'll be A-okay. But here's the problem. If you're still seeing deposit outflows so you can go borrow money from the Fed and get some cash, guess what? It's still a loan. It still has to be paid back. And the terms at the maximum are a year. Now, if you could convince your customers to stay, which would be critical here, I don't know if this is possible, but maybe the banks could borrow from their Fed, putting their assets as collateral, go out and buy some short-term T-bills that are paying a premium rate compared to their portfolio, and try to keep their customers there and hope a year from now things worked out. Don't know that that works, because as I see the problem, money's still going to flow out. There's going to be still stresses on these banks, and even with the government guarantees, we can still see them fail. And we're not the only ones with that view, as a major lender just pulled a whole bunch of money to lend out to the regional banks. They did this yesterday. Key lender in regional bank raises a whopping $88.7 billion via bonds. This is a huge amount, as the U.S. system of federal home loan banks is wrapping up the amount of cash it has available to deploy, as the failure of several U.S. lenders, including Silicon Valley Bank and Signature Bank, stoke expectations that more regional lenders will need to tap it for funds. And again, there's no question they're going to need to. There's literally none, because as we see deposits flow out, guess what? They're going to need cash. And not only they're going to need it, but they're going to need those deposits to come back. And the FHLB system, a key source of cash for regional lenders, raised a whopping $88.7 billion through the sale of short-term notes, and that was more than $64 billion than initially planned. So here you can see what's going on is they believe that this problem is going to get much worse, and the Federal Home Loan Bank is saying, hey, we've got the cash if you need it. And believe me, they know these regional banks are. The system of 11 regional banks is a Depression-era backstop that private banks can use for short-term funding without the stigma of taking money from the Fed. It's widely seen as a safety net. It's been called the lender of next to last result, a play on the nickname of the Fed's famed discount window. And of course, there's little doubt we're going to see banks tap this. The question is, can they stop the outflow of deposits? And this leaves us now with a big question, because this day next week and tomorrow this time next week, the Fed meets and we get to find out, are they going to raise rates or not? And today's CPI report, well, may suggest that they will, even though they can't see that the problem in the banking system is because they've been raising rates. The U.S. core CPI tops estimates, pressuring Fed as it weighs the hike. We see the gauge rose 0.5% in February and 5.5% from a year ago. And the core CPI, because it excludes food and energy, is seen as a better indicator of underlying inflation than the headline measure. Here, let's take a look at this chart. And what do we see? Well, now we've got the core CPI in blue against effective federal funds rate in red. And what do we know? In the past, what do you see when the core starts to go sideways and shows that it perhaps is no longer peaking? You tend to see the Fed cut rates. Now, we also have note the Fed has cut rates ahead of the core peaking. So what do we see right now? Indeed, the core CPI, while still remaining high, is coming down, which leads us to wonder, is it slowing at a rate fast enough for the Fed to pause here? Is the banking system actually having enough problems that the Fed perceives they're the problem? Or does the Fed say, no, our new little backstop program, our little $25 billion is enough to fix this. We don't think people are going to borrow from it because, well, maybe they're going to go to the Federal Home Loan Bank instead. And nevertheless, then the Fed says, look, see, the problem's been resolved and we still need to bring inflation down, because the headline number says the overall CPI climbed 0.4% in February, over 70% due to shelter, and 6% from a year earlier, which still says to the Fed, inflation's running hot. And as Jerome Powell has told us, they're not going to quit until the job is done, or maybe they're not going to quit till the banking system collapses. I'll let you be the judge of which is likely to happen first. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.